Hey guys, this is a very different video than what I've done before. Everybody knows that markets have been making all-time highs almost every week, and many are worried about the valuations of the market. This especially reminded me of a conversation with the CIO of a very large fund house last year. Everybody in the industry knows that I'm a big fan of Bajaj Finance. So at the end of the meeting, the CIO leaned towards me and said, "So just tell me that you've been selling your shares." What shocked me was not the fact that he wanted me to sell, but the conviction with which he said it was not to do with the share itself in question. But according to him, it is important to sell if the price of a particular company shoots up very, very high. That is called common sense. To do something very different may be considered to be foolish, greedy, and maybe undisciplined too. So there's an old saying that goes, right, it is never wrong to take profits. Investors in general will forgive you if you take profits and the shares or the fund goes on to make tremendous amount of profits. Remember, in your performance data, the investment manager doesn't capture the foregone upside. But on the other side, just imagine that you held on to a stock or a fund and that kept falling. It is very well captured in the performance data. Just remember the fate of the investment manager. He'll not just be asked but chastised as to why is he holding on to a losing proposition or a losing fund or a losing stock. Isn't this so very wrong? And that's the reason why most of the fund managers very coolly go out and book small profits. Fine for the investment manager's life. But what about you as investor? What about his clients? Investors, clients, everybody need to understand that equity investing is an asymmetric proposition. While the upside for not selling a good stock is almost unlimited, the downside is naturally protected, isn't it? And therefore, it is not just wrong to book profits, but it could actually be a big mistake. I'm not saying that this should be applicable for all your funds. We as investment managers do have self-discipline for certain set of funds, but not for all funds. Sadly though, most of the investment managers don't do the right thing for investors. According to research, over 60% of the global stocks in the last 28 years have delivered less than 1 month return, treasury bill returns. Then now you may question saying, why should I invest in stocks at all or equities at all? Of course, that's a good question. It is because of superstar companies. The entire active fund management industry is focusing their attention to identify the next superstar company, isn't it? But the thing is, identifying is one thing, holding on to the stocks that you've identified is one another thing. But sadly so, the current attitude that is displayed in the financial industry is not the right attitude as per me. The whole point that matters is the compounding long-term effect of these superstar companies. Ideally, these superstar companies go up 5 times and then they go up another 5 times. Great compounding, isn't it? So let me give you a practical example. In 1999, Alibaba approached Goldman Sachs and offered a 50% stake for $5 million. Goldman Sachs came out and said 5 is risky, 3 is fine, and in a matter of 5 years the stake was worth $22 million, a 7-fold increase, guys, and that was the best in that period. Goldman Sachs cashed out. Great, isn't it? The only point is today the same stake is worth $200 billion, almost double of the entire stake of Goldman Sachs in toto. When asked, Goldman Sachs team said, "We just wanted quicker results." I understand this example is a little out of the box, but the point I'm trying to say is that it is very, very wrong to book profits on a superstar fund or a superstar stock. In spite of all this, when you meet people in meetings or in gatherings, all they ask is, "Bechna kab hai?" Nobody says, "What is our whole discipline?" I find it very weird that investors try to save 0.5%, 1% of their fund management charge by going direct or giving their money to robo-advisors or whatnot. It looks to me like they're penny wise and pound foolish, because if you analyze the cost or the impact of on your returns is your inability to hold on to these superstar funds or stock, which is way higher than this 0.5%, 1% cost. So next time when you meet or hire an investment manager, of course ask him for his sell discipline, but please do ask him for his hold discipline too. I hope you like this video. Thank you for watching. Please do ask me questions.